Okay, so here we go. How to invest like a pro. Quick disclaimer, this is not a solicitation for funds. Any investor has to be an accredited investor to invest through our PCG Fund 4. That's our next investment opportunity here. There's the picture of the building, one of the three buildings we're purchasing with our next fund here. When I say fund, I mean single purpose entity to buy one property or one portfolio of properties, which we're now working on here in this portfolio of assets in South Ironbound, Newark, New Jersey. So since 2013, Seth Martinez and I here at People's Capital Group, we've been helping investors build and preserve their wealth through bespoke real estate investment opportunities located in northern New Jersey by repositioning multifamily and mixed-use buildings. We strictly focus on apartment buildings and mixed-use buildings here in North Jersey within about an hour commute to Manhattan. We do sometimes stretch a little further out, about 90-minute commute, but we try to focus on this North Jersey market. And we've realized about 282 transactions together, Seth Martinez and I, over the last 13 years here at People's Capital Group. And we're about 113 investors, about 83% reinvestment rate upon a liquidity event. So we try to be very transparent in our operations, do what we say we're going to do, find great deals, and manage them with our in-house property management company. However, it all starts with underwriting. It all starts with looking at the deals, and we'll look at 100 deals to buy one. But you have to be able to underwrite deals quickly, effectively, not spend hours underwriting a bad deal, and kind of have a first level, a quick look at deals and then know when to dig in further, and then what to look for when you're digging in further so you're not wasting your time on bad deals. So we're going to talk about that tonight and how we vet deals, red flags to look for in an operator and an opportunity. Key questions you should be asking. We have 10 key questions you want to ask an operator when you're investing in one of their opportunity or considering to invest in their opportunity. We're going to go over a couple case studies, two good ones and one that's struggling, right? Because every operator has challenges, right? If you meet an operator that says, oh, I've never had a deal that didn't perform as planned, well, they just haven't done enough deals. So we'll talk about two that are overperforming and one that's struggling, why it's struggling, what we're going to do to solve those issues. We'll go into our summary here at People's Capital Group, and then I'm going to just dip into our next investment opportunity here at the very end. So let's talk about vetting deals, or underwriting opportunities. This is arguably one of the most important processes and parts of finding great deals, right? Making sure what you're investing in makes sense for your investment goals. So where I like to start, okay, because we look at a lot of deals, right? I get so many deals in my inbox, so many this and that. First of all, have your buy box. Know exactly what your buy box is, what your investment box is, right? 90-minute commute to Manhattan, 40 to 150 unit apartment buildings in northern New Jersey with at least rents 10% below market value, class A, B, and C. Okay, that's our buy box. That's what we stick to. So if I get a warehouse in Delaware, I'm not going to open the email. I'm not going to bother. I'm not going to waste my time. If I get an apartment building in way down in South Jersey, right? I might open the email just to kind of see what's going on in South Jersey, but it's not in my buy box. So I'm not going to spend the time underwriting it. Okay, now from time to time, you can adjust your buy box, right? We like the Lehigh Valley, like we're looking at areas there. But for the most part, if you have your buy box, you're sticking to it and don't waste your time with deals that don't meet your buy box. Oops. Okay, so first of all, what's the story, right? I always like to know the story first because that tells me a lot about the situation generally, right? And situations create opportunities, right? Generally, tough situations for sellers create good opportunities for buyers. So what's the seller's motivation? Are they in foreclosure, right? We're buying a package of properties, this one in Newark here, it's in receivership. That means the lender is foreclosing on the developer who just finished building these three buildings in 2024 and 2025, and he owes $22.5 million on them. We're trying to buy them for around $18.5 million. So we're getting them at about a $4 million discount, less than what it would cost to build these buildings right now today. And they were finished in April of this year. And they're about 90% leased up. So the seller is motivated. In fact, it doesn't even matter what the seller wants at this point. He's lost control of the asset. The buildings are in receivership. They're legally being managed by a management company, and the lender is going to determine what offer they accept. It's an off-market deal. It's not sitting on the internet, right? And that's the types of deals we like. We go direct to the lender, the seller, whatever the situation is. And we do that by knowing the right brokers and wholesalers and landlords and lenders and attorneys and getting in on the deal quickly and effectively. And we get the jump on these deals because we've been doing so many transactions in New Jersey for so long. Another reason to focus on a market, hone in, be a market specialist, and be the person who does a lot in that market. You will develop relationships. And once you start putting large commissions in realtors' pockets, they call you first when they have a great deal. And they don't really want to mess around with a bunch of buyers. They'd rather just work with one or two good buyers, and you want to be on the top of that list. So what's the history of negotiation with the seller, right? I mean, this deal right now that I'm buying, I offered 18.3 million about 11 months ago. They countered me at 20.5 million. I said, no, thank you. Good luck. Now, almost a year later, they've come back and said, well, would you still offer 18.3 million? I said, no, but I'll offer you 18 million. And they're now at 18.7. So we'll probably meet in the middle, hopefully 18.3. So what's the history of the negotiation, right? That's important understanding kind of the story there. What are the other offers on the table? What's the market bearing? That's another reason you want to be close with your realtor, your wholesaler, your landlord. They're gonna, if they like you and they know you, they're gonna expose what are the other offers on the table. Hopefully they're telling you the truth. But that's gonna tell you what the market's bearing. All right. So I was just bidding on another property recently, and I could go up to 7.5 million. I knew the wholesaler very well. She said, okay, we have another offer at 7.5 million. I said, okay, I'll match it because I can go up to that number. But originally I was at 7, right? And knowing where the other offers are allowed to get the deal. Now, with that deal in particular, the seller was like, oops, I have another $750,000 mortgage on title I didn't know about. So a lot of times you get these distressed sellers and they're just a disaster. So that's part of buying distressed deals. Sometimes they get a little messy. They can waste your time. So secondly, what's the numbers? Right, what's the price per door? Right, I could tell right away on a deal, class A, B, or C, where it's located, what city it's in. I know my markets that I invest in because I hone in and focus on these markets. What's the price per door? That's going to tell me a lot about the opportunity. It's not going to tell me everything, right? Because a class A building is going to be a lot more expensive price per door than a class C or class B. But this Class A building we're buying in downtown Newark, the price per door is about 290, maybe 293, depending on where we land. I know for a fact to build this new would be like 310 per door, right? So I know for a fact I'm getting it for low replacement value, but it's a brand new building just being leased up. Secondly, what's the value add potential? All right, what can we do to increase value in the property? We only buy deals where we can increase the value of the asset. We don't buy properties where you could just sit on it, collect a 5% coupon, and hope the market goes up. All right, some firms can do that. We don't do that. We want to perform well for our investors. High teen IRRs, consistent cash flow, consistent value add opportunity, and you only get that with rents below market value, deferred maintenance, and mismanaged assets. At least one of those three. Maybe not all three, but at least one of them, depending on the asset. Sometimes all three. Um, and thirdly, what's the cash flow targets? What's the IRR targets to LPs, right? And that's a pretty, you want to know that number. Now, if you're getting a deal as a buyer, you're not going to know those numbers right off the bat. Your underwriting team or you as an underwriter are going to figure out those numbers. Take a grain of salt with the realtor's numbers, of course. Put in your own figures where needed. Notice I don't have on here cap rate. Okay. Now you might say, well, that's the first thing I look at is cap rate. It's not the first thing I look at, right? When I'm buying a value add deal, I look at the cap rate. It's a consideration. It's not everything. I'm not really putting that much weight on it. It's going to be considered. I mean, it's something certainly investors and ask about, and it's something we know, but it's not all that important. I'm looking at a property right now that has 45% vacancy. So I'm buying it at a cap rate of like 1.6% because it is terribly mismanaged. There's fire damage to 2 of the 6 buildings, right? So cap rate isn't everything. Now, if you're buying again for more of a buy and hold, long term, no value add, yeah, your cap rate's important. And you want to consider your cap rate when compared to your interest rate and so on. But if you can buy a building with value add potential and increase that cap rate from a 4 to an 8 over a 2-year period, well, then it matters a whole lot less what your cap rate is going in. It's important to know that number, but it's not the end all be all. Thirdly, how's the market? Right? What are the cap rates for this market? Right? What's the resale cap rate? Right? A lot of times we're buying properties at like a 4.5 cap because they're huge value add deals. So the cap rate stinks going in. But the cap rate on the exit, I'll put it at a 6 or 6.25, right? Whatever the market calls for on the exit. I don't assume cap rates compress. I don't assume interest rates compress. I don't assume we see the rent growth we've seen for the last 5 years, which has been an anomaly. Right, I assume conservative market assumptions. Cap rates are what they are today. They're high. Prices are low. Interest rates are what they are today. Interest rates are high, right? Um, so what is the cap rate though for this market? What is the resale cap rate on the building? What is the purchase cap rate too? But again, take that with a grain of salt depending on the value add strategy. Inventory on the market, right? Is there a lot of inventory coming to market? What's the saturation rate of rentals on the market? Is the market flooded like Phoenix or Dallas or some of the areas in Florida where you see these over building of markets, or is it a restricted market like Northern New Jersey where it's hard to build? And yes, there is a lot of inventory coming online, but it's actually not enough inventory. We are short about 3 to 4 thousand units a year here in New Jersey. It may not seem like it. You drive around, you see all this development going on, but we are short 3 to 4 thousand units a year in New Jersey. There's an insatiable demand for housing. There's just not enough inventory. That means our rents stay strong and our property values stay high. Thirdly, rent control, right? Is there rent control in the market? We obviously try to avoid rent control. We do understand a lot of the buildings we're looking at do have rent control. What is the rent control? Is it likely to change? What are the local politicians saying, right? Look at New York City right now. They may have a socialist mayor voted in who's going to do a rent freeze. And, how's that going to affect landlords, right? So understand what the local politics are in the cities you're investing in and recognize they can change. All right, they can change quickly. We like to buy non-rent controlled buildings, obviously, and new construction is rent control exempt in New Jersey, which we like a lot. And other markets in New Jersey really don't have that bad rent control. You can navigate it pretty nicely. Um, all right, now let's dig into the operator, right? Because the deal is about 40% of it. I'd say the operator is 60% of it, right? When making the right decision on who and what to invest in, right? Because a good operator can take a mediocre deal and make it perform. A bad operator can take a great deal and fail, right? So the operator is really more important than the deal itself. So, what's the operator's experience in that market, right? Do they do a bunch of different markets, a bunch of different types of assets, or are they honed in on one market and one asset type? What's their infrastructure? Do they have in-house property management, or are they at the mercy of third-party property management? Not to say every syndicator who uses third-party property management isn't good at what they do, but I found my experience with third-party property management was dismal. And we had to develop our own management company before we could really even afford it. We got to about 50 units. We developed our own and lost money for many years because that asset was huge and that infrastructure allowed us to reposition apartment buildings much more aggressively and successfully for our investors. A loss of LP principal, right? Have you ever lost an investor's money? Now, we've never lost an investor's principal. We've lost money. We've wrote a check at the closing table on some fix and flips, but we made sure our investors never lost their money. Capital calls, right? Did you run out of money and have to go back to your investors and ask for more money? We've never done that. Anytime we've gone over budget on projects, we've wrote the check ourselves. And we make sure to have lines of credit and available cash reserves so we can put in our own capital as needed in deals if ever needed. LP reinvestment rate, right? How many of their investors reinvest after a liquidity event? That's very important. It should be north of 75% in our opinion. Current deal performance. How are your current deals performing, right? And listen, every operator right now tends to be struggling. Cash flow is very elusive. We have challenges with cash flow on a number of our deals, but our value is there. Our equity is there. Our investors' principal is protected. We didn't get floating rate loans and things like that. We recognize rates were going to increase. We generally bought for a pretty decent price. Location. Lastly here, is the location desirable? Is there strong population? Right? Is new inventory coming to market? What's the public transportation in the area? Are there jobs? Are there companies? Is there a primary or secondary market? That's one of the reasons we like Newark. Right? So, oh, Newark, it's got high crime and terrible schools. Yeah, it's an inner city area. It does have that. That's correct. However, it has a growing population. It doesn't have that much inventory coming to market. It has very strong public transportation. You jump on the PATH train at Newark Penn Station and be in New York City in 18 minutes. You could jump on New Jersey Transit at Broad Street and be in the city in 20 minutes. There's tons of jobs. You have Prudential, Audible, Mars Wrigley, Rutgers, some great universities there. The Prudential Center, you have the downtown area, the Ironbound area, very nice nightlife and restaurants and so on. It is a secondary market to New York City, where New York City is the primary market that we work off of. So, does your operator know their market, and is that a market with growth potential? All right, so now let's talk for a second about underwriting deals and just making sense of all the deals you're looking at. Because as you start building in relationships with operators, realtors, and so on, and syndicators, you're going to start getting a lot of deals in your inbox. So this is how we underwrite deals. Okay, we have 100 deals that initially come in, right? I use those kind of back in the napkin metrics right off the bat. Isn't in my buy box? No, I'm not going to look at it. What's the price per door? What's the value add? What's the play on it? What's the story? Right. So as soon as I know that right off the bat, 70% of the deals I'm not going to waste my time with. 30%, they're probably worth looking at. So we do a back of the napkin underwriting. I'm not going to pay my underwriter, who's a very in-depth underwriter who costs a lot of money to underwrite these deals in extremely in-depth Excel models. I'm only going to have them underwrite the very serious deals that pass the top 30 here. So the first 30 that I'm going to look at, back the napkin, Google Drive, Google Sheets spreadsheet, very simple spreadsheet. I'm going to punch in a few figures, a few numbers, and within about 3 to 5 minutes, underwrite this. We call it back the napkin underwriting. Right? If it looks good there, I'm going to dig in a little deeper, tighten up my back of the napkin, 15, 20 minutes. Now, if it looks good, I'm going to shoot it over to my underwriting team. I'm going to spend some money on the deal. All right. That's generally the top 20 deals that we look at. Okay. If they pass the back of the napkin. Out of those 20 deals, we'll submit generally about 20 LOI, 10 to 20 LOIs. Generally, one of our LOIs is accepted out of 10 to 20. Once we put the property, once we've signed LOI, we go into contract. We have a data room with all the due diligence for our investors. Offering documents, full set of diligence on the assets. Subscription agreements and capital is collected within a 30-day period. And then after closing, we do quarterly cash distributions, ACH right to our investors' account, monthly and quarterly updates, quarterly financials, and annual K-1 tax forms that we try to get out far before the March 15th deadline. Want to make sure your operators get those K-1s out on time too, because that can be frustrating as an investor. So we make sure we do. We have in-house bookkeeping. We run a pretty tight ship here, so we get those K-1s out quickly. All right, so that's the underwriting process there to kind of not waste your time with bad deals, have your high-level underwriting, and then dig into the deals that make sense. Now let's talk about red flags, what to beware of. So a little bit of repetition here, past loss of investors' principal. What happened? How will you prevent that from repeating? I mean, I know very good operators that have lost people's money. What was the situation? Did they do everything they could to protect it? Did they actually take a really messy situation and like somehow salvage most of the investors' capital back out of it? Did they like repay their fees back in or something like that and try their best to like make good on the situation? Right? Or was it like a complete loss and they threw their hands up and gave it back to the bank and said, sorry, should have read the fine print, right? Were there capital calls? Again, some larger syndicators are doing capital calls right now. Or what they're doing instead of a capital call is they're doing a rescue fund, right? A preferred rate fund. I'm not going to say any names. You've probably seen them out there. And listen, it's not to say that if you invest in these preferred rate funds, you're going to lose your money. They go in front of the guys, the common equity that already invested their money in these deals. And now these deals need rescue funds. So they go out and they raise a preferred rate fund. That's a very common thing. I'm seeing shops do that are far larger than us. And that's a rescue fund. That's what that is. And they very well might succeed in what they're doing, salvage the deal, save the deal, get it back on track, and do well for everyone, common and prep equity. But understand what capital calls they've have they ever done a rescue fund, and what situation are they in with their current deals. Another red flag is low investor reinvestment rate. Minimum of 75% of past investors should reinvest after a liquidity event. Okay, we're at 83%. That shows how well your communication was, how well your performance was, and are your clients satisfied with you? Now, listen, it's never going to be 100%. People have personal situations. Right. It's just whatever the situation is, you need the money back to invest in your kids going to college or a health situation or you're buying a new home, right? So it's never going to be 100%. But you generally want to work with investors, operators that are getting about three-quarters at least of their investors back into their deals. That means they're generally doing what they said they were going to do. No market experience, right? Are they new to this market? If so, what is their plan to mitigate risk? Why are they entering this market? Right? Is it a great deal they just couldn't turn down? Yeah, listen, that's not necessarily a bad thing, right? They might have found a great deal they couldn't turn down. We're looking at something near Scranton, PA right now. It's like an incredible opportunity, right? And it's just like we're direct to the seller, the receivership opportunity, and there is a way to move into new markets. It doesn't mean don't do the deal. It's just what is your plan to mitigate the risk? Who are you going to hire? What are you doing to staff up in that area? Why are you moving into this market? How is the market perform in general, right? So it's not necessarily a deal killer, but recognize the story behind moving into that market. High fees, unfair split, right? Are the fees industry standard? Generally, you're going to see a 2% asset management fee. Okay. Operators need to keep the lights on, pay rent. There is a cost to raising capital and so on. So generally, you're going to see a 2% asset management fee, which should be 2% of rent collected, right? That's a performance-based fee. That's what we charge here at People's Capital Group. That means you have to go out, collect rent on the property, create income into the company, and you get 2% of that to cover your cost as a company, the bookkeeping, the reports, the software for the investors, all those things cost money, right? Our software costs, $6,000 a year that our investors log on to and get access to. And then all these things cost money. So you have to charge basic fees to cover these costs, bookkeeping and so on. But there are companies that charge ridiculous fees, right? You have disposition fees, which we don't charge, but we see that out there. Um, uh, Mortgage signing fees, right? A fee to sign for the mortgage. In our opinion, that's kind of your job as a GP is to sign for the mortgage, whether you PG it or not. Hopefully you don't. I'll personally guarantee it. But even if you do, that's kind of your responsibility as a GP. So, other fees you can see, sometimes, I mean, if it's a huge construction job, you'll see construction management, which honestly, for a construction job like over $2 million, that can make sense. And in property management, right? We own the property management company. We charge a 3% property management fee, which is industry standard. That's a complete wash for us because the cost of property management is concrete. And generally, every dollar that comes in goes right to the staff and the labor and the cost of managing these assets, which sometimes is even more than what we're collecting on property management. Acquisition fee, right? We charge a 2% acquisition fee, 2% of the purchase price. We roll that into the deal. That's part of our equity in the deal, right? So understand, are the fees industry standard, which acquisition fee of 2% is industry standard? Is it rolled into the deal? Is it kept and so on? What is the preferred rate of return in waterfall split? Okay, generally a preferred rate of return is going to be between 6 to 10%, depending on the deal, depending on the waterfall split. And there's a lot of variables here, right? You might get a higher preferred rate of return, but then a less attractive waterfall split, right? You might get a 10% pref rate, but then a 40-60 on the back end with investors getting 60, operator getting 40 or 50-50, right? Or you might get a 6% preferred rate, but then an 80-20 on the back end with investors getting 80, right? So it's not all cut and dry. It'll depend on the deal. Some investors prefer a higher preferred rate, kind of protect their investment, and a lower piece of the waterfall split. The waterfall split is what you earn on the refinance, on the sale, on the big liquidity events that happen. The preferred rate is more your payment through the life of the deal, but also it accrues over the investment and is a compounding accrual. That's a whole other class. And then also in comparison to the fees, right? So some groups charge a lot of fees, but then they give away all the returns on the waterfall and the preferred rate, right? So, and that's neither here nor there, right? That might be your preference. You might say, I'd rather collect like a really strong pref rate and a really attractive waterfall split, knowing that this group charges really high fees, but they have to keep their lights on and make a profit too, right? So that might be your preference. You invest in a group like that. Or you might find one in the middle that's more like industry standard fees, industry standard pref rate, or again, maybe a really low pref rate and a less attractive waterfall split, but super low fees, right? That might be your preference. There's no right or wrong answer really when it comes to this. Optimistic assumptions. So finally here on this slide, what is the operator assuming, right? Do they assume cap rates compress? They assume rent growth remains strong. They assume interest rates drop. Now, personally, I think interest rates are going to keep dropping. The Fed has indicated they're going to do two more drops this year and potentially two or three in 2026. I think rent growth remains strong because building starts have dropped off a cliff and there's less and less inventory coming to market. And it takes 2 to 3 years to build a new apartment building. So you're not going to see another boom in building for another 2 to 3 years in inventory hitting the market. I think cap rates do compress personally, right? But I'm not going to underwrite my deals like this because then I'm being too presumptuous. I'm being too optimistic with my assumptions. You want to assume basically right now we're in a market that has high cap rates and low prices. We assume in 3 years when we go to sell, market's going to have high cap rates and low prices. Right now we're in a market where rent growth is kind of stagnant, maybe 2, 3%. So we put rent growth at 2.5%. I mean, 5 years ago it was 8%, right? You can't assume it's going to be the middle of that, 5 or 6%. That would be crazy. That's a way too optimistic assumption. Interest rates. Yeah, we all kind of think as interest rates are going to drop. The Fed has indicated nothing but. You can't assume interest rates drop. Who knows what the next set of data is going to do? Who knows what the Fed's going to do? Right? We don't. So you want to assume interest rates remain where they are at least today, which are pretty high. Expense growth slows. I mean, it's hard to say where inflation is going to be, right? So inflation is at least 2%. Your CapEx contingency minimum should be 20%, right? So if you have $1 million in renovations for a property, you should have another $200,000 on top of that and just unknown unknowns, right? A 20% contingency. Your vacancy factor, depending on the size of the asset, your vacancy and the class of the asset, your vacancy factor should be between 3 to 6%. We're normally running a 4% vacancy factor. I'm sorry, a 5% vacancy factor. On buildings that are like over 150 units, you could do like a 4% vacancy. For buildings that are over like 300 units, you could do like a 3.5% vacancy. For Class A buildings, you might, depending on the size and the location, you might do a lower vacancy. For Class C buildings, you're going to do a higher vacancy, right? Also, the location plays a role. Bad debt. Bad debt is when a tenant owes you money and moves out and doesn't pay you. So again, a Class C building in a rough neighborhood, you're going to have at least 1% bad debt. A Class A building in a great neighborhood, you might have 0% bad debt, right? So you want to understand what is that bad debt number going to be. Time to renovate units, right? Are you doing crazy renovations and new HVAC systems and permits and moving walls? Or how long is it going to take you to do that? Oh, 30 days? Really? I mean, when it takes 30 days just to get a permit, that's not realistic, right? Or you just throwing paint on the walls, replacing some door handles and light fixtures. Maybe that will take 30 days. Your time to lease units, right? Are you going to lease a unit in 2 weeks? No, give yourself 60 days to lease a unit. You need time, the leasing agents, to go out to the unit, take the pictures, market the property, hold the open houses, qualify the applicants, review the applicants, sign a lease, get a time for the tenant to move in, everything. It takes time. Even if you have a waiting list, it still takes time to lease units because tenants aren't ready to rent right away. They generally need about 30 days to move into a unit at the very least. And it generally takes about 30 days to select the right tenant. So we'll do 60 days to renovate often and 60 days to lease is generally what we're underwriting with our deals. All right, so here's 10 key questions we feel you should be asking your operators before you invest. All right, so how did you source the deal? Ideal story. I'm all about the story. I think the story makes a lot of sense. I've completed over 300 transactions in my career. Seth and I have done about 280 plus together. The story matters. The story tells you a lot. How many full cycle deals have you performed? That's important, right? We've done about 12 syndications here. So People's Capital Group, 6 of which have gone full cycle. 2 of them performed ahead of target, 2 right on target, and 2 just slightly below target, right? So And quite frankly, if your operator is like, yeah, all my deals are amazing home runs, it's like, it's kind of a red flag. You want to dig into the numbers a little bit. In reality, you generally have, 30, about a third are going to be really good deals, about a third are going to be right on target, and about a third are going to be like a little bit subpar. Right? And that's just kind of how uh, life is sometimes. Market cycle, whatever, you have challenges with renovations or, contractors or rent numbers or whatever the situations. Capital calls, loss of LP equity. We talked about that. Debt and equity structure, right? Are you getting bridge debt? Are you getting long-term agency debt? Bridge debt can be good because you can leverage your investors' capital and borrow more from the bank and essentially get higher returns for your investor, but there could be more risk to it as well, right? Agency debt, and that could be good too, but it's going to give you a lower LTV and give you less debt and probably lower your IRR to investors and make the deal less attractive on the return metrics. Pref equity. This is preferred equity. We're not huge fans of preferred equity. It means investors get paid, a certain group of investors will get paid first before other investors, right? And that's kind of what I was talking about previously with these rescue funds. These deals that these large shops are doing, they need, a cash injection of $2 million. So instead of doing a capital call to investors, which looks really bad, they go out and they raise the $2 million from other investors and they slide it in the capital stack as a preferred equity position. Generally, preferred equities earning between 12 to 16% on their money. Once they earn that 12 to 16%, they're out of the deal. That's usually how it's structured. So they have equity until they earn a certain high preferred rate of return. And once they achieve that rate of return, they're out of the deal. But they get paid first before the common equity. It doesn't mean it's a bad deal. It doesn't mean you shouldn't invest in it. Just understand what's the preferred equity in the capital stack and are you comfortable with it? Preferred equity can also boost common equity returns, right? In a deal that's not really performing, maybe it's like a 13 or 14 common equity return. You take a third of the capital stack, you make it pref equity, you lock them in at 15% or whatever. It can boost your common equity returns up closer to 20. So it can be a way of juicing a deal to make sense of an opportunity, but you got to make sure the deal can withstand the pref equity risk. Preferred rate of return and waterfall splits. So you have a preferred rate of return, basically a rate of return the investor earns before the waterfall split takes place. Generally, that's between 6 to 10%, normally like 7 to 8%. That's where our preferred rates of return land. Is it compounding, right? Like, so every month, if we don't achieve that preferred rate of return, it gets added to the principal. And then next month, it's that percentage of that higher principal amount. So it's a compounding preferred rate of return. I don't have that on here because it's a pretty in-depth question, but is it a compounding preferred rate of return? That matters when you are talking about a long-term investment that's not actually achieving that preferred rate, right? Because you might be owed an 8% pref rate, but the deal only makes 2% a year. So that 6% difference gets added on your principal every year, right? Or does it not get added on your principal? Is it just accrued and kind of paid on the back end? And again, the waterfall split, how do you split the profits after that preferred rate of return is achieved? The length of the investment, right? Is it a 3-year investment, 5-year investment, 7-year investment? Most investors these days are looking for shorter term investments. What's the exit plan, A, B, or C, right? Generally, we want to sell after 3 years or refinance and then sell by year 5. What happens if the market's bad? What happens if the market's good, right? What's your 3 exit strategies? Your future assumptions, we talked about that in the last slide. Fees and what fees are rolled back into the deal. We touched on that as well. Timeline to invest. This is important, right? Maybe you're having a liquidity event coming up and you're not going to have the money for 90 days. And they're drafting the PPM now and they're going to have a 30-day window to invest. And that starts in 2 weeks. Well, this deal really isn't going to work for you, right? So what's the timeline to invest? And you want to be honest with your operator because if you tell them, yeah, I can invest, I'll figure it out how to get the money, or maybe my deal will close sooner than I think, then you're not being, transparent to your operator, and that's going to harm that relationship when you sign for the money and then you don't have it, right? You don't never want to do that as an investor. Co-invest from the GP, right? It's important that they're rolling in their AC fee or, putting in additional capital beyond that. It's not necessarily always required, especially depending on the GP experience. If it's like their first deal, you're going to want to have them have some skin in the game for sure, or one of their first deals. Okay, let's get into case studies here and talk about some real deals we've done. Here's 105 Marion Street in Paterson, New Jersey. This is a 25 unit we're about to sell, and nice, beautiful brick building there. This is an old warehouse that was converted into condos. By the way, if you have any questions as we go along, put them in the chat here, and I will answer all questions here at the end, and we will go over all these questions here. Okay, and I encourage questions as we go along here. All right, so let's talk about this building here. This was a 27 unit complex here in Rahway, New Jersey. We are planning to refinance this asset next year. We have a 3.8% interest rate locked in until November 2026. So we're not in a rush to refinance. We bought it for 2.75. It should appraise around 5 million or so. Bought it beginning of or into 21. This was 27 units. It was being run as a boarding house. It's legally zoned as a boarding house as well. Now, lenders don't like boarding houses. Buyers don't like, rooming houses, they're also called. So we're getting the legal zoning converted over to an apartment building. I'd say these are Class C units we've repositioned into Class B. Quartz countertops, nice sinks that are like motion censored. We put about 346,000 into it, but more money as the years have gone on. We've recycled some cash into it. We are also producing cash flow to our investors on point. Our goal was to increase the rent roll by 30%. We are up to about 67%, a 68% increase in rent roll to this point. Our goal was to convert these short-term rentals into long-term rentals. We did that. Improve the tenant base, the common areas, and building exterior. We did that as well. New roof, new siding, updated some of the exterior with landscaping and so on. And so we're going to be ready to refinance this and ideally achieve overperform to investors on this asset here in Rahway, New Jersey, just a few blocks from the train station. By the way, Rahway, New Jersey, great market. Check it out. It's definitely a good market. We've done very well there. We plan to hold on to that building, not sell it, because we see a lot of long-term potential with Rahway. Here's a PCG Fund 3. This purchased a 42-unit apartment building in Passaic, New Jersey. This was just in December, actually. We bought this for about almost 7.7 million here. Renovation budget's just over $1 million. Target about 20% annualized IRR to the family office share class. The higher end share class, about 18 IRR for the lower end share class for credit investors. Target annualized Class B cash and cash return, about 9.2%. So this we bought with a agency loan, a Fannie Mae loan. We did not get bridge debt. We're going to do a big refinance after year 3 here, beginning year 4. Target about 81% of investors' capital back to them, and then sell into year 5. Now that's plan A. But quite frankly, if the market's really good for 3 years and it's a great time to sell, we're just going to sell this asset. If we can overperform to investors, we're going to sell the asset. Because people love getting their money back. And if you can, lock in a great buyer at a great price on a deal in a hot market, then take advantage of that and move the property. We raised about $4.1 million for this property, about a 2x equity multiple over 5 years. This is a 42-unit Class C building we're repositioning into a Class B. The backyard's filled with trash. We cleaned it out, put a nice barbecue area and a nice playground back there. We have a nice, the basement was filled with trash. We cleaned it out, and we have a nice common laundry in there and storage as well. We put about 30 storage units in, which we're leasing out to tenants. And we're renovating units as we go, as they become vacant. We've found that we can convert a lot of units into additional bedrooms, right? This is a very Hispanic demographic here in Passaic, New Jersey. And bedrooms really are important to this demographic. So we are finding that there's room in these units to convert 2 bedrooms to 3 bedrooms or 1 bedrooms to 2 bedrooms. So we're doing that in a lot of this building. And that's increased the budget a little bit, but it's really increased the rental amount we're getting on these assets, on these units. So good opportunity here, fully funded. We've distributed $45,000 to investors since purchase and cash flow. So those are 2 opportunities that are going well, really ahead of target or on target at the very least. And but let's talk about when things don't go according to plan, right? Because even strong operators with good infrastructure and a heck of a track record are going to have challenging deals, right? And that's where really the strength of an operator comes out, right? How well can you turn around a deal that's being hit from all ends with challenges? Here's a 21 unit building we bought in Bayonne, New Jersey. Right off the bat, it was the height of the market. Right? Looking back, this was February 13th, 2023. Interest rates were high, locked in a 6% interest rate. Prices were still high. Cap rates were low. Prices were high. The market had not been affected by the high interest rates yet. It was not a good time to be buying real estate. I mean, it was a good opportunity in the market based on the data we had, and we went forward with it. It's in a good location, but we've had a lot of challenges with it. We got held up by the town for many months. We were told we don't need permits for certain things, and then they ended up saying, "Oh, now you do need permits." We had other challenges with the town saying, "Oh, you need architectural drawings or load calculations," and just not getting back to us, not being very transparent, and holding up our project for many months on end and being extremely difficult to do business with. So we've had a lot of challenges in Bayonne here. We like the market overall, but dealing with the town has been very frustrating. So that held up the project and caused us to have higher costs on the project. Um, We've had to pause distributions to investors on this. Now, I don't think the property's underwater. I think we have a decent amount of equity in the asset. We've renovated about 13 units in this building. We bought it with about a $21,000 heating cost. We installed mini splits in all the units. Now the tenants pay their own heat and the units have a nice AC situation as well. So we've made the building kind of from a class C or a B minus into a solid B. Um, and we removed $20,000 in heating costs off our books, and we put in energy efficient water heaters. That saves us about $6,000 a year. So overall, about 21 grand in heating costs, $6,000 in water heating costs, about $27,000 added to the bottom line in expenses, and we've increased the rent as well in the building about 18%. Now we have a plan to increase the rent about another 18% or so over the next 18 months. So we're pretty aggressively working with a lot of the tenants to bring the rent up to market value. We have a plan for every single unit in this building. We just went over it with our property manager today. We have certain tenants that are still far below market rent, not rent controlled. We're going to be more aggressive when rent increases on those units. We have other tenants that are closer to market value and a plan to bring them up to fair market over about an 18-month period. So we do feel that as rates drop and prices ideally grow and cap rates compress, we should be fine. We should be able to achieve our initial target goals to investors on this investment. But we've got a lot of challenges. So we've had to write a check ourselves to cover some additional costs on this building. But that's what good operators do when they run into a tough spot. So this is a building that, again, we bought at the height of the market. Prices were high, interest rates were high. Looking back now, Monday morning quarterback, probably not a great time to be buying real estate, but at the time it appeared to be a good opportunity. And then we had the town hold us back for months on end with ridiculous requests that came in piecemeal. All right, we want architectural drawings. We go out and get those, and they'd review them for 2 months. They say, oh, now we want load calculations. We go out and get those and review them for 2 months. Oh, now you need to get this permit for, you got to upgrade meters here. It would piecemeal information the whole time, holding up the entire project with a number of vacant units. So really difficult scenario with the town, and we worked our butts off to get through it as quickly as possible. So, kind of Murphy's Law on this deal, but we're still chugging along here, moving forward. We're doing very well with it. Again, I think we have decent equity in the asset. We'll harvest that equity at the right time by selling the asset in about 2 years, and we'll continue to increase rent. We have a plan for every single unit in this building. So we're making sure that we do everything we need to do to get back to distributing cash flow to investors and get the project back on budget as well. And we'll keep working on that until the day we sell this asset. So that's the plan for this building, but it goes to show not every building is going to perform exactly as planned, but you want to work with good operators that are going to solve those problems day in and day out, dig into the numbers, be creative, and just be persistent with their work ethic to make sure they solve these problems. You don't want operators that go to you with problems. We go to our investors with solutions. Say, here's the challenge and here's the solution. Right? Whenever I go back to my investors with our monthly updates, we always say, here's the challenges we're having, and here's the solutions we're implementing to these problems. Right? We want a solution-based operator because problems will always arise, and it's our job to find solutions to them as operators. So right now we're working on PCG Fund 4 here at People's Capital Group. Again, I encourage the questions as we go along here. Um, and we focus on value add opportunities in northern New Jersey here um, with below quality management. We operate within the underserved part of the multifamily market that's too small for larger institutional groups to get into, less than 150 units, but larger than what small mom and pop investors invest in, generally over 50 units or at least 40 units. Uh, Deal sourcing is everything. You make your money when you buy in real estate. So we have a network of brokers and attorneys and wholesalers, developers, owners, lenders to get unique access to off-market opportunities. Vertically integrated with in-house property management and service providers to make sure we're operating efficiently and effectively on our buildings. An investor-first approach where deals are executed with our capital partners top of mind. We only move on deals where we can get high IRRs in the high teens to our investors, and we look for cash flow as well on deals. We do extensive due diligence, institutional level due diligence on these properties, and provide maximum transparency with monthly updates, quarterly financials, and quarterly cash flow distributions. 8.6% average rent roll increase per year throughout our portfolio. Average annualized cash and cash return for full cycle deals is 15.1. 12 completed syndications, 83% reinvestment rate after a liquidity event. Here's our management flow chart. That's me focused on capital raising and our team there. There's Seth who handles the operations and oversees property management and capital management. We have about 20 contractors that work for us. They are independent contractors. We keep it lean and mean, but we make sure we have a good team in place and we keep our contractors very busy to get our projects done effectively on budget and on schedule. So here's our 5-year plan here. We closed on an $8 million building in 2024. This year, we're working on selling one or refinancing one asset. We're also acquiring one other asset. We're raising around $10 to $20 million to ideally acquire a $20 to $40 million building. 2026, we plan to raise about $25 million to acquire roughly $50 million in assets, sell or refinance another one or two assets. We plan to double that into 2027 and then start harvesting our assets in 28 to 30 to really get those nice liquidity events for investors. Right now, our opportunity is to invest in a 62-unit Class A fully managed portfolio alongside us here at People's Capital Group. These properties are on Mulberry Street in Newark, New Jersey, and they are in receivership. We're buying them for around the mid-18s. The developer owes about $22.5 million to the lender. So it cost about $22.5 million to develop these buildings. They were finished in April this year. They're 90% leased up. We can buy them for about $4 million below that cost. That's a good deal here. That's the types of deals we try to find. Rents are about 10% below market value, light value add to increase cash flow to our investors. We'll sell them over a 3-year period. Here's the top shot here, the corner of Emmett and Mulberry Street. Nice little portfolio right next to each other. Parking. Newark, New Jersey, really a thriving little city. If you haven't looked at Newark, New Jersey, check it out. It's really a great area to invest, in our opinion. Some people say the next Jersey City. So, we all saw what happened in Jersey City and Hoboken, just incredible skyrocket in value. Here in Newark, you have really good infrastructure. You have the Prudential Center, you have the Sports Illustrated Stadium right over the river, the Red Bull Arena there in Harrison. You have the NJ Performing Arts Center, NJ PAC. You have the light rail, you have the PATH station, the PATH line, you have Newark Penn Station, Newark Airport, a number of highways as well. Newark Broad Street, NJ Transit. So a lot of great infrastructure there in Newark, Rutgers University, Prudential, Audible, Mars Wrigley, a lot of Fortune 500 companies, and nice parks as well. So there's parts of Newark that are less desirable. There are parts of Newark that are more desirable. We like to focus on the downtown area, Ironbound sections, and North Newark is where we're focused on. This building is in the Ironbound section, South Ironbound section of Newark. This is a 3-year investment, 3 adjacent buildings built in 24 and 25. We're targeting quarterly distributions paid pari passu. Target 4.5% annual distributions that target start date of Q1 of ownership. $100,000 minimum investment in Class B, although for first-time investors with us, we can bump that down to $50,000. That's a 7% preferred rate of return. $1 million minimum investment in Class C, that's an 8% preferred rate of return. That's for our ultra-high net worth individuals, fund of funds, institutional groups, and family offices. Class B target is 16% IRR. Our Class C target is 17.5 IRR. That's your annualized internal rate of return. Class B target equity multiple over 3 years is 1.5 x. So on a $100,000 investment, you'd expect to walk away with $160,000 over 3 years. In the better share class, Class C, you'd expect to walk away with about on a $1 million investment, you expect to walk away with about $1.6 million over 3 years. Target tax depreciation from year one is 50% of LP investment. So when we buy a property, we do something called a cost segregation study. We front load that tax depreciation and give that out to our investors. So on a $100,000 investment, you'd expect about a $50,000 passive tax write-off in the year we buy the property. We plan to close on this in 2026. So if you have passive gains, this is a great way to write those off. If you have passive gains expected for 2026 or even 27, because you could roll them over, it's a great investment to write off those gains. That 50% of investment in tax depreciation or tax loss is very useful to many LP investors. We do accept 1031 exchange capital and self-directed IRAs. If you are selling a property or you own a property, an investment property you're considering selling, or you have a property on the market, let's get in touch. All right. If you want a 1031 into one of our deals, don't call us the day before you close, right? We need to really talk sooner. The 1031 is a little more complicated. We structure a tick. There's more moving pieces. So we need to talk to you sooner than later. I'm going to put a link in the chat to get in touch with me here and a member of our team. But if you have a self-directed IRA or a non-self-directed IRA, if you just have a traditional or a Roth or a 401k, you want to roll some of that into real estate, we do accept self-directed IRA funds. We can guide you in that process and help you connect with the right IRA custodian. If you have a property you're looking to sell, you want to harvest that equity and move that into a passive investment here with People's Capital Group, we can help you do that as well through a 1031 exchange. Or if you just want to invest cash, of course, cash is king. We have over 100 investors that invest with us, about an 83% reinvestment rate. Here's a little blurb on our PCG property management, vertically integrated, of course, zero capital calls, and focused on really getting these properties repositioned aggressively and efficiently. Here's our timeline on the deal. We plan to place the asset under contract here in November 2025. We'll look for LP investment commitments by December 2025. That means the money has to be wired to the account in December of 25. Due diligence complete by 2026 of January. Loan commitment by February. Closing by March. That may be accelerated, but we want to be conservative at this time. April would be our first quarterly distribution. October 2027, we plan to have the asset stabilized about a year after ownership, about 18 months or so. And then by March 29, we plan to exit the asset, have our liquidity event, and cash flow on a quarterly basis along the time of ownership, about 4.5% cash flow per year along the time of ownership. So I'm going to go over the questions now, but I'm going to put a link in the chat here to schedule a call with me, Aaron Fragnito. Hopefully you learned a little bit today about how to underwrite opportunities, how to underwrite operators, how to efficiently go through deals and not waste your time with bad deals, and also more information about us and how we operate here, how we help people build and preserve their wealth in real estate. This is a great off-market deal. We're buying for an incredible price below market value, basically a brand new piece of real estate that's in the lease-up phase in foreclosure that we can snag for a great price. So if you want to get in on this deal, I'm going to put a link in the chat to schedule a call with a member of our team. We do work with family offices and institutional groups that kind of fill up the pot pretty quick. So if you want to get a soft reserve in the deal, we are opening up soft reserves pretty soon for this. You'll want to talk to a member of our team, have your questions answered. Make sure this is a fit for your investment goals. Make sure you qualify as an accredited investor. So I'm going to put that link in the chat here now, and then we'll go through our questions.